Hey, everybody. Welcome to the What the Wealthy Do podcast, where we pull back the curtain and show you how the rich make money moves and how you can apply those same moves to yourself while you are on your wealth building journey. I'm your host, Stephanie Dorsey. I'm also the CEO and co-founder of Margins Capital, where we provide access to women and people of color to an institutional quality portfolio of alternative investments. Welcome. And we are still talking about my very favorite thing. And today, specifically, we're going to be talking about the Mac Daddy of alternative assets or alternative investments, which is private equity. Everybody, clap your hands for private equity. Yes. I like me some private equity. We're doing it here at Margins Capital. We have invested in a private equity fund, but we're also buying companies and doing direct investments in a portfolio of companies, including a med spa, and we're currently on the market for a SaaS company. So yes, I believe in private equity. Today we're going to spend some time breaking down just like what it is, how it works, what does it mean, and if you want to invest in it, you can refer back to the last week's episode where I talked about all the different ways to invest in alternative markets. Before we get started, I have to remind you that this episode, as well as this podcast, is intended for financial education and not financial advice. So let's talk about it. What is private equity? Private equity is when a company or individual decides to buy or take an ownership stake in a private company. And so this private company, again, not to be confused with a public company, shares can be bought and sold on the stock exchange. These private equity firms or individuals decide to buy another private company. Alternatively, you can take a public company, a company that has stocks that you can buy on a public stock exchange. So you can buy their stocks on Robinhood or Fidelity or Charles Schwab. You can take that public company private. And that happens a lot. That most recently happened, I think it happened with Walgreens. Girl, it happens all the time. And most recently it happened with Electronic Arts, so EA. It was one of the largest private equity deals, I think the largest private equity deal of all time. And it was worth $55 billion. And I think only 3 organizations was a part of that deal to take EA private. So the goal of private equity is you're buying this company, not to just hold, but the goal is to buy it and improve it and make it more valuable and then sell it for a profit later. So think of it in terms of basically you're flipping companies instead of just like flip this house. Like instead of flipping a house, you're flipping companies. So how does it work? There are basically 5 stages. The first stage is fundraising. And so a lot of these firms or an individual can raise money from institutional investors or individual investors to take down companies. The second is if you have multiple investors, you form a fund or a syndicate or special purpose vehicle, right? Because you might just be forming this entity for the purpose of buying this one company. The third thing is you find the company that you want to buy, which, trust me, takes a lot of time, right? Because even though you'll hear now that there's so many companies and the silver tsunami, all these companies that are for sale, everything doesn't necessarily is valued at what you would pay for it or aligns with your particular goal. So acquisition, big bucket. And then a part of that acquisition is diligence, right? So you have to find the company and then you have to make sure the company is what it says it is. And like I said, aligns with your goals, and then you acquire it. The fourth thing that happens is you create the value. So you get to it and you decide that you're either, it just needs more marketing. It needs more technology. It needs more like a technological, it's just completely analog. And then with these technological enhancements, it will become more efficient. Maybe it is bloated and it has cost-cutting measures. That's the sketchier part that can become the sketchier part of private equity. You hear those horror stories about private equity firms that buy hospitals and they fire a lot of people to reduce costs and it becomes a less than ideal place to work. However, on paper, it looks like a more valuable asset. But I'm going to say this, all private equity firms are not created equal. So you do have some private equity firms that are just like scorched earth and they do not not care about creating real value. They just care about creating value on paper. But all private equity firms are not like that. And you would be doing yourself an absolute disservice by deciding I'm not investing in private equity because of what this one bad apple, because there's so much value to be created and wealth to be created in the private equity asset class. So don't play yourself. Don't cut off your nose to spite your face. Don't do it. And then once you create the value, then the thing to do is exit. And you can exit by either going public or by selling to another larger organization or another individual. But the thought is you've created value. And so now the company that you originally bought is worth more today than it was yesterday. Yesterday's price is not today's price. So again, when private equity works, it really works. If you look at Apollo Global, Blackstone, KKR, these trillion-dollar companies created all of their wealth through investing in private equity first, and then they expanded to invest in different asset classes. So let's talk about the different types of private equity. One very popular kind of private equity is called leverage buyouts or buyout private equity. And that's basically, in addition to the money you've raised with other institutional investors, you take out a loan to buy the company. And so on a smaller scale, it can be an SBA loan. On a larger scale, like that $55 billion EA purchase, those entities did not put up the $55. They basically took a loan for a portion of the $55 billion value. They took out somewhere probably between 50 to 70, maybe even 80% loan to buy that company. You do want to be careful because you want to have a manageable loan to value ratio so that you can service the debt, because that's what happens while a lot of these companies end up going bankrupt. Like Toys R Us, they bought the company and the debt service ratio was way too high. And so it's unfortunate. And so that's why they have to go bankrupt, because the loan and how much it costs to pay the loan payments every month is just too high. So growth equity is another type of private equity. So you buy a company that's already doing well, but it needs an influx of cash so that it can expand. So like, for instance, you have someone that owns gyms. Like maybe you opened up 10 gyms and you want to expand to go nationwide with your 10 gyms. You might need a private equity dollars to come in and put in more money so that you can open up gyms across different states or across the nation. So that's what growth equity is. The business is already doing well, but in order to make it to the next level, you need some additional capital. The third type of private equity is venture capital or early stage investing. Basically, venture capital is like the cousin of private equity, but it's like when you invest in an early, like kind of a startup and they're at an earlier stage. And so you're not taking a majority stake, but you're taking a significant stake, like 1 to 20% stake in the company to help it grow. The goal of venture capital is to invest early and ride the wave as it grows. So imagine it's someone who invested in the earlier stage of Uber would basically be a billionaire when they went public, or at least worth hundreds of millions of dollars. The fourth type of private equity is distressed private equity. So if you buy a distressed asset because you know you can turn it around, or you know you're going to buy at a cheaper price or a discounted price because it is distressed, and you break it up and sell it off. If y'all remember Pretty Woman, that's literally what Richard Gere's job was. He was buying companies that were in slight distress and he broke it off and sold the parts, and the selling of the parts was worth more than the whole put together. See? Y'all know this stuff. You just didn't realize you knew it. And then lastly, real estate private equity is when you buy real estate that has a business associated with it, like buying a car wash or a hotel or a chain of car washes, frankly. The point is you're buying a real estate not necessarily just to buy and hold and for you to live in, but you're buying it because it generates capital and there's literally a business associated with it. And not to be confused with buying an apartment that you're going to Airbnb. Airbnb. It's different. It's a little bit more complicated than that. So the wealthy love private equity, and partially I shared a chart a couple of episodes back where private equity has outperformed the S&P market for the last 15 or so years. It is a wonderful way to add diversification to your investment portfolio. There's a wonderful way to get outsized returns. Like if you think about even Reginald Lewis, I mean, there's so many stories of people who became so wealthy through private equity. But Reginald Lewis is absolutely one of them. He was doing really great. He had his own law firm, but it wasn't until he bought McCall Pattern Company. And that's what really made him a millionaire. And then after that, he bought Beatrice Foods, which back in the 80s was one of the first billion-dollar private equity leverage buyout deals that the world has seen. So yes, money, 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 money. Money. All right, so what you need to know before deciding whether or not you're going to invest in private equity, one is if you're not buying the company for yourself to run, you have to be an accredited investor. An accredited investor is someone, as an individual, you make $200,000 a year for the last 2 years, or as a married couple together, you make $300,000 a year for the previous 2 years, or you have a net worth of $1 million that does not include the value or equity of your primary residence. There's this thing that's happening where they're trying to democratize or make these type of investments more accessible. And so if you Google, there may be some platforms that have private equity investments available. But for the most part, this is still pretty gate kept unless you decide to buy a company yourself. So yeah, unfortunately, that's the game. Also, the capital commitment could be pretty large. Like if you're buying it yourself, again, the capital commitment is going to be thousands of dollars. And if you invest in a fund, the average fund, it's going to be somewhere around $100,000 or more. But if you get yourself involved in certain ecosystems, namely Margins Capital, but there are other ecosystems that you can get access to type of deals where you do get to invest for a lot less than $100,000 or even $50,000. So you just want to get plugged in, and there are ways for you to learn, but you're going to actively plug in because the SEC does have limitations on how funds can market. So some of the reason why you don't hear about a lot of this stuff is because the SEC has our hands tied behind our back, but most of it is because this area of the world and investing is still pretty gate kept. But once you start to do your research and start to find different organizations to plug into, path becomes illuminated. And then also, once you invest, the lockup period for investing in private equity can be pretty extensive, at least about 7 to 10 years. So plan for that. That's how long it takes for you to buy a business and then improve the business and then exit the business. If you invest in a fund, they have what's called 2 and 20 in terms of fee structure. And so that is 2% of your investment will go towards paying the fund's fees and basically keeping the fund alive. It goes to salaries, any other type of costs associated with managing the fund and managing the business. And then the 20% is once the business is sold, once your earnings exceeds a given threshold, and that varies depending on which fund you invest in, then the general partner of the fund will share in the returns. So if you make $1 million, they will get to keep $200,000, and then you will keep the other $800,000. All right, and then the last thing I want you to be really like, I need you to learn about this, and we're going to do an episode on this, but due diligence. Do your due diligence. You need to make sure if you decide to invest in a fund that you know everything you need to know about that general partner or fund manager, that you trust that person, that they know what they're talking about and they know what they're doing, and that they have a track record and they can actually do what they say they're going to do. We have heard a lot of horror stories, especially, oh my gosh, in today's world with Instagram and all of this, it is the wild, wild west. And so you need to run background checks on these people. You need to talk to them. You need to talk to people that know them and that could vouch for them. When I invested in the private equity fund that Margins invested in, I had met the fund manager. I had talked to a couple of people on the fund manager's team. I I talked to other investors that invested in the fund manager, and I talked to individuals who knew the general partner and that could speak to his character and his experience in the space. So you need to do a background check, basically. This is a real life background check on who this person is that you're investing with. And then if you decide alternatively to invest in a platform, I want you to do research on the platform. It's basically getting reviews, right? You want to figure out, is this platform trustworthy? What has happened in the past? Will they be there for you? And then lastly, you want to make sure you're doing due diligence on the underlying company that you're investing in. Does it make sense what they're trying to do? Can they do it? Does it make sense what they're trying to do in light of where the macroeconomic or where the world is? Are they trying to bring digital cameras back, or are they trying to push the envelope forward in terms of all of this technological advances that are happening? So things like that. Does their unit economics, does that make sense? Like, are they going to make money? Can they make money? So there are a lot of things that you need to do in terms of evaluating whether or not it makes sense to invest in this particular company and or fund and or SPV, or special purpose vehicle. And then lastly, we talked about, I mentioned it before, all PE firms, private equity firms, are not created equal. So just because it's private equity and private equity on a whole has outperformed the S&P market, it doesn't mean that this particular fund will. And also, you need to make sure that this particular fund aligns with your values. Are they going to go buy a company and basically strip it for parts and leave the company to go bankrupt in your wake? Is that good enough for you? Is this a company that's going to build another alligator Alcatraz? Is that good enough for you? Making money by any means necessary? These are things you need to evaluate when you're evaluating a private equity fund, as well as their underlying investor thesis, or their investor strategy, the type of companies that they want to buy. Also, be thoughtful. President Trump has written an executive order that is going to allow 401ks to invest in private equity. Again, all private equity investments are not created equal. So just because this private equity investment is available on your 401k's custodial platform, that doesn't mean that it makes sense for you to invest in it. So make sure you can do your research. You want to have as much control as possible, because when you invest in a fund, you don't have any control. So you need to make sure that you feel really, really great about that fund and that fund manager before you give them some of your hard-earned dollars. But again, I want you to remember, private equity is not just for the wealthy. It is a wealth building playground, but it ain't just for the wealthy. And so as the wealth gap continues to widen, largely due to super wealthy people investing in private equity, you need to make sure you're investing in educating yourself. It's so important to do that. And it's so important to join communities where you can learn from others, because if you care about building wealth, private equity is a really, really good asset class for you to consider adding to your portfolio. I mean, the wealthy have used this playbook for decades, and it is the hill that I'm going to die on as the representative for Margins Capital, but also just myself, that I educate as many people as possible about private equity and the value that it can create for you in your investment portfolio. So if you found this to be helpful, please share this episode with a friend. Don't forget to like, comment, and subscribe to wherever you like to consume your podcasts. We are going to continue our conversation about alternative investments. We will be talking about venture capital next week, the sexy cousin of private equity, and I look forward to seeing y'all. Bye.